welcome to this week's episode of The Wealthologist, where we dive deep into the realms of financial planning and wealth management. I'm Chris Hobart, your host, and today, I wanted to unravel the intricate connection between psychology and your money or investing. Now, in the world of finance, it's not just about the numbers. It's also about how we psychologically react to the numbers, sometimes without even knowing it. This concept is what we call behavioral finance. And that's helped illuminate the fact that our minds can oftentimes play tricks on us, which can lead to decisions that might not be in the best interest of our portfolios or our long-term wealth building. So I want to explore some common biases. And then very importantly, I just want to share with you maybe a couple of strategies to help navigate them for a more disciplined and perhaps a bit more of a rational approach to investing. So first, let's dig into the different types of behavioral biases that exist. First one is what we call overconfidence bias. Now picture this. You've had a couple of successful trades and suddenly you feel invincible. I was just in Las Vegas and I saw people gambling thinking they were invincible. We've all been there, right? Overconfidence bias can lead us to overestimate our market understanding or our luck. Now, when you figure this out, I think the best thing that you can do is embrace humility, and you can also diversify your investments, which can help you navigate through the highs and lows more effectively. Look, we can't win every time. Second thing is confirmation bias. Now, we all love to hear when something confirms our beliefs or we're told that we're right? But that's what's called confirmation bias. Now, I recall a time when I was fixated on a stock due to positive news, and it caused me to ignore red flags. What do? Well, this is when seeking diverse viewpoints can be really helpful, and you begin to engage with contrarian thinkers, and that's since become my strategy for a more well-rounded perspective. And we do that in the company as well. Our team has differing strategies or perspectives to help us avoid this type of bias. Third thing, loss aversion bias. Now, let's talk about the fear of losses. Oftentimes, we can hold on to a losing investment for too long. And the reason is you haven't set a clear exit strategy, or you haven't been objectively reviewing your portfolio regularly to make decisions based upon rational analysis rather than the fear of locking in a loss. Fourth thing, herd mentality. Now, have you ever found yourself on a trend simply because everyone else is? Think Beanie Babies, or today, Stanley Cups. Herd mentality can be tempting. And I've seen markets get swayed by fads. And the thing is, maintaining a long-term perspective can become a great anchor against short-term fluctuations. And that's what I'd recommend. Fifth, anchoring bias. And this is when you fixate on a specific price point. And this can be a psychological trap. I remember one time being anchored to a historical price, only to realize that the better decision is based upon fundamental and technical analysis, because they can be much more reliable than just some arbitrary price. The thing is, you got to stay flexible in your expectations, and that's become kind of my mantra. Now, I want to share some personal strategies to help you build some bias-resistant investment strategies on your own. First and foremost, and you've heard it time and time again from so many people, diversification. My portfolio roller coasters that I've been through in my life have taught me the value of spreading my investments around. And it helps reduce that emotional roller coaster associated with individual stock performances. Sure, individual stocks are fun, but this helps diversify that risk. Also, having clear investment goals is important, because in the chaos of market noise, having that clear long-term goal, it can be a great guiding light, which helps prevent impulsive decisions that can oftentimes be wrong. Also, implementing a systematic decision-making process checklist. Checklists like that have saved a lot of us from making emotional decisions or reactions. And using these standardized criteria can help you have a comprehensive analysis tool to help in the heat of a kind of a crazy moment. Finally, seeking professional advice. Now, I've learned through the years that financial advisors can be invaluable with their insights, because a good advisor can give you great advice that might counter your decisions, but can help you avoid some of these biases. You see, in the world of investing, psychology plays a role, and understanding and overcoming behavioral biases is a journey that we've all got to navigate. We're all subject to that. So in the weeks to come, we're going to be talking more about this in the Wealthologist, and we're going to be sharing insights to help manage that fascinating intersection between psychology and wealth and figuring out different ways in this economy to build your wealth. Because remember, it's not just about the numbers. It's about understanding how you react to the numbers, how you react to the economy, and what you can be doing to best serve yourself, your finances, and your family. We're always here to help. Let us know if you have any specific questions. Thanks for tuning in.